Good afternoon, everyone. This is Mary Rutherford, President and CEO of the Montana Community Foundation. My little iPhone tells me it's just about 1:31, and we might have a few other folks calling in, but in the interest of respecting your time, we're going to go ahead and get started today. Thanks for joining us. Those of you who've called in, if you wouldn't mind, if one person could weigh in, any of you jump in and tell us, confirm that you're able to see the slides okay?
Yes.
Wonderful.
Yep, I see them, yep.
Hi, Pam, thank you.
Hi, you bet, thank you.
Oh, thanks, Tracy, for raising this technology. It's so cool. I can see that Tracy's saying, yep, she's got it. So if you wouldn't mind, all of you who have the ability, go ahead and mute your phones so the background noise doesn't interrupt our call. And you can press *6 to mute your line anytime during the call, or *7 to unmute your line. Also, we typically record these webinars and then we upload them to the website. So know that this call is being recorded for purposes of continuing education. We're so happy to have you all joining us today and to also be sharing some pretty exciting things that are happening here at the Montana Community Foundation. As you'll see on the slide, we have a few general updates about MCF. First and foremost, in November, our board met and elected new officers, and I wanted to let you know that Dale Woolheiser, who is living in Missoula, originally a Miles City boy, actually is now chairing our board of directors. And also, many of you know Mary Craigle from her years of service with the Community Foundation. She continues to serve as the chair of our investment committee.
And I'm here today, and I just wanted to really quickly say welcome to everyone. We're thrilled that you took the time today, and I'm sure you will be very happy at the end of this webinar to hear the performance, and particularly excited about our new partnership with Cambridge. I can tell you the investment committee had a number of wonderful proposals, both near and far, and but no better than Cambridge, and we are so honored and so excited about this ability to enter into this long-term partnership, and just thrilled that Omar could be here today to provide his update.
Thank you, Mary. So many of you may be paying attention to our Infinity e-newsletter or have looked at our website, but I did want to take a minute to introduce to you the fact that we have a few new staff. We're so thrilled to have Casey Tollison as our new controller. Casey comes to us, she's another Montanan who is originally from Malta and spent a good 15 years or so out in the world of auditing, both in the Portland area and Coeur d'Alene. She's a Carroll College graduate and has joined our team to lead up our finance and accounting department. So Casey's joining us. We also have Kay Gray as a new staff senior accountant. And then we have Kayla Meniger, who is our staff accountant as well. So we're happy to have those three new additions to the finance and accounting department, a whole new department, staff. We also have added Caleb Stumberg, who is heading up our internal constituent record management, IT, database systems within the organization. Those are the two newest groups of staff that we've added. I hope that if you've had any questions, Caleb probably has been a person who might have answered those, especially as it relates to funds, et cetera. And of course, we still have Daphne, who many of you know. So we're super excited about the new staff that we have on board and how well the whole team is gelling together. I titled the next bullet point, Systems Go, because we've had a lot of excitement over the last 6 months or so, and one of those was some challenges with technology that kind of, frankly, we lost about 3 weeks in our many of our systems, as our technology company that we outsource our services to helped us rebuild those systems, and some of those were our financial systems. So as you can imagine, there might have been a little bit of a ripple effect there relative to year-end statements and updating the portal, but we're happy to report that all of those system glitches have recovered, and you should be able to go online, look at the portal, see fund balances through March, and April's processes are well underway, but through the end of March, we're happy that all of the portal updates are complete. Endowment payouts went out, and pretty pleased to have some of those things taken care of. Many of you know that we purchased some real estate, and we actually now, some Montana real estate. We purchased Aspen Court, which is about a 20,000 square foot building on Helena's Walking Mall. And this building was actually formerly the Goff Shanahan Law Firm. And some of you who know Montana history know that the Goff Shanahan Law Firm was the longest standing firm in the state. It was in existence for about 160 years before they decided to no longer exist as a firm. And as a result of that, Aspen Court was available for purchase, and it was a great investment. We used partially some of our real estate portfolio, dollars available in our portfolio, as well as some commercial debt. The State Bar of Montana is one of our tenants, the Human Rights Bureau, and Hattersley Walter Law Firm, as well as the Helena Area Community Foundation and the Montana Community Foundation. So we closed on October 30th. We did a light building refresh. The building was fully leased immediately and occupied, and all systems seem to be working there. Looking ahead, we as an organization will really be spending FY18 honing in our internal systems. You're not going to see any new big initiatives rolled out. We're going to focus on, to use one of my dear friend Arnie Siegel's phrases, we're going to be working on doing good better at the Montana Community Foundation. Part of that is a nice segue into our discussion today with Cambridge. As part of our rigor with all of our practices, every 5 years the Montana Community Foundation examines the investment advising relationships that we have and goes out with an RFP. And as Mary Craigle mentioned, the investment committee, it was, well over a year ago, it was probably February of 2015, that we invited prospective firms to come and present. We invited actually 4 of the, 17 RFP respondents to come present to the investment committee, and we made a change. And this goes in line with our desire and our objective of being the go-to place for a variety of things, but primarily philanthropy here in Montana. And so we've announced many times this change to Cambridge. We've talked a lot about the great things that Cambridge brings to our organization in fulfillment of our mission and hopefully assisting families and organizations across Montana to make sure that the things that they care about today are provided for long term. We have actually here in the room with us today our advisor with the Cambridge Associates, and it's really sad that you all can't see him because Omar is wearing a fabulous, I'm going to call it lilac colored shirt with a fabulous pink and white tie. He looks quite snappy. Flew in late last night, spent the day already with our investment committee reviewing our portfolio and returns, and then spent some time with our staff doing some kind of staff development work relative to our long-term goals and objectives. Without much further ado, I would be happy to introduce to you Omar Sanchez, who will talk about our portfolio.
Thank you, Mary. Thank you for that introduction. So very nice to be here on in Montana and on the phone with all of you today. there were really 4 items on the agenda that I thought would be helpful to cover as we talk about the portfolio. First, which is a very brief overview of Cambridge Associates as a firm. Secondly, we wanted to walk through our approach to managing portfolios, our investment philosophy. Third, we wanted to spend some time talking about what's been happening in the markets to give you some context for the performance of the portfolio. And then last but certainly not least, taking a look at the performance of the portfolio and how we're positioned today. So why don't we start with the next slide and talk briefly about Cambridge Associates. We are a global investment firm offering a range of customized investment solutions to our clients. This includes outsourced and discretionary investment management. This includes advisory services as well as research tools. We very much pride ourselves on providing conflict-free advice to our clients. What that means is that we don't have products and we aren't compensated to put managers in our client portfolios, so our interests are very much aligned with you. We also pride ourselves on the strength of our research platform, which we really do think is a differentiator. We leverage this platform across 11 offices globally to really try to find not only the best managers of today, but the best managers of tomorrow and get our clients access to those managers. We currently either oversee or advise on roughly $160 billion in assets, with the bulk of our business endowments and foundations like the Montana Community Foundation. If you look at the top box on page 7 here, what you'll see is that we've got a broad range of clients by size, and roughly a third of our client base is very similar to Montana Community Foundation in having assets at $100 million or less. So a very core part of our client base is clients just like the foundation. So I've been at Cambridge personally 9 years. I am a managing director at the firm, and I'm part of our outsourced discretionary investment management business, CA Capital Management, and I am also a member of the investment team that manages this portfolio on a discretionary basis. Let me go to the next slide if you don't mind. So let's talk about our investment approach, and it really does start with a long-term orientation. In order to achieve the goal of preserving and growing purchasing power, you really do need to shut out some of the short-term noise that you hear in markets and focus on applying an investment approach and focus on applying that investment approach consistently. What that means at Cambridge, in terms of the framework that we use, is that we build growth-oriented portfolios, typically portfolios with a meaningful allocation to equities, and we use alternatives, namely hedge fund strategies and strategies of a similar risk profile, as well as liquidity sources to target a risk profile that is very much aligned with the foundation's risk tolerance. We emphasize active management when we think it will add value net of manager fees, and if we don't think we can get that kind of added value, we're perfectly happy to index, and we do have index exposure in this portfolio as well. Now, this is very important, and we'll have a chart to talk about this in a moment. We do not market time or change portfolio positioning based on a specific macroeconomic view. We will, however, tilt the portfolio towards more attractively priced assets and away from expensive ones. And then lastly, in terms of risk management for us is not a model and it's not a number. It is very much a process that's integrated into everything that we do. It starts at the beginning of a relationship when we work with the foundation to set the policy that is aligned with their risk tolerance. It continues with the mix of asset classes that we choose to achieve that targeted risk profile. It's diversification across strategy, across style, across geography, across capitalization, and so forth. It's how we size positions so that no one position determines success or failure. It's monitoring both our intended and our unintended bets and making sure that we're minimizing the unintended bets as much as possible. And again, above all, it's a process, and it's very much part of everything that we do. Thank you. So what are the main building blocks of the portfolio that we use? As I mentioned, we build growth-oriented portfolios, and what that means is that we emphasize equities, both public and private investments, to really drive portfolio growth. But because we all know that equities are more volatile, we use what we're calling here hedged strategies. This is long-short equity, absolute return-oriented hedge funds, as well as some less correlated, more liquid strategies to lower the overall portfolio risk profile while ideally giving up less upside than if we were to just use bonds to play that role. And then the final building block here is that we create liquidity buckets to support spending and essentially allow you to buy time during those environments when equities will likely be underperforming, particularly periods of sharp, unanticipated inflation and periods of severe economic contraction or deflation. Now, I mentioned earlier that diversification is an important part of our risk management process, and we've included the chart on the next page to try to make that point. And I apologize because this is a very busy chart, and I'll try to draw out the main points for you here. So this is what we call the quilt. It shows the performance of major asset classes over the last 15 years, and we rank them from best performing at the top to worst performing at the bottom for each of those years. So the first point that I would make here is that, as you can see, leadership among the best performing asset class tends to rotate over time. So for example, if you look at 2009 and 2010, looking at those yellow boxes, that's emerging markets equities. Pardon me, these were among the best performing asset classes in those years. And then look at 2011. It was actually the worst performing asset class. And then look at 2012. It was once again the best. So that performance can rotate. And so this is why we don't load up the portfolio on one particular asset class, but rather we really do try to get broad exposure to as many asset classes as possible. And if we can do that, what that will mean is that we'll never be the best performer, but it also means we'll never be the worst performer. And over time, we're going to be among the better performers in terms of that return profile with a more consistent return. And you can kind of see that if you look at the orange boxes in this chart, which represents essentially a portfolio that is equal weighted to these different asset classes. And generally, as you look at from left to right, with a few exceptions, but generally, that portfolio tends to hover between the mid and top half of the performance of these different asset classes, such that over the full period on the far right-hand side, which represents the full period return from 2002 to 2017, having that diversified exposure gets you in the top half of performance with a much smoother ride. And that's really ultimately what we're trying to go for here. So one of the other points that I do think is really important to talk about is market timing and why we don't do it. And so this chart on the next page, yeah, you're right there, sorry. And on this chart, what this essentially shows is the average annual compound return of the S&P 500 over the last roughly 38 years. And that's the dark green bar on the left-hand side. We then show the return of the S&P 500 over that same time frame if you were to remove the 10 best returning days over that entire time frame, if you were to remove the 20 best days, and if you were to remove the 30 best days. And so as you can see, looking from left to right, missing just even a handful of days can dramatically reduce your return. And for example, just to give you a sense of that, going from 11.5% to 9.5% annualized on a $1 million portfolio, just missing those 10 best days is a difference of $32 million over 38 years. So it is meaningful. And that's why we don't manage the portfolio in a way to go in and out of markets, but really do try to take that longer term view, because we really think that market timing can cause a lot of damage to the portfolio. So why don't we switch gears and talk about the markets for a moment. So if I were to highlight key themes in the market currently, they would be the following. First is what we're calling this risk assets rally. When I say risk assets, I'm really referring to global equities, U.S., non-U.S. developed and emerging markets in particular. And actually, this is a rally in these assets that actually started before the November elections last year, and they picked up significant steam after the election, and that rally has largely continued today. Now, I would argue a major driver of the post-election rally has been some excess enthusiasm about the ability of the new administration to push forward its pro-growth agenda, but I would also acknowledge that there have been signs of improvement from an economic fundamental basis, both in terms of economic growth and then more market-related strong earnings growth. So there has been some positive fundamentals to underlie this rally. There continues to be geopolitical and policy uncertainty, which continues to remain elevated, whether it's gas attacks in Syria, the Eurozone elections, the Brexit, or more recently the tragic attack a couple of days ago in Manchester. We live in an increasingly uncertain world. The final theme that I would note is more specifically focused on the valuations for asset classes, the prices that are currently charged for these asset classes. We would argue that most of these asset classes are fully valued and in many cases more expensive than their longer-term average. And so what that means is that the opportunity to buy cheap assets is more limited today than it perhaps has been in the past. So looking forward, in terms of our outlook here, it wouldn't surprise us to see some limited volatility as markets price in these different risks that I've described. In any case, we're not positioning the portfolio for any one specific outcome, but rather instead remaining focused on managing a very well-diversified portfolio that's really built to perform in a variety of environments and ultimately win over the long term. So on the next page, we show you market returns. These are market returns by asset class, starting with global equities on the left, moving to U.S. equities, non-U.S. developed equities, and so forth. So as I noted earlier, these risk assets in particular, the blue bars, have really led the way, and that trend has continued into the second quarter. I'm going to give you some returns verbally. This is not on the page, but just to give you a sense of that, for the year to date through a couple of days ago, U.S. equities are now up 7.1%, non-U.S. developed markets are up 12.2%, and emerging markets equities are up 16.1%. So it continues to be a very strong year for these equity risk-oriented assets. Valuations, this is what we call our valuation matrix. This is our assessment of the attractiveness, the relative attractiveness of these different asset classes. The key takeaway here is most assets are either fully to overvalued, depending on what asset class you're looking at. We think that U.S. equities in particular are a bit more expensive relative to their long-term average. We think that there's more attractive relative value in non-U.S. developed markets as well as emerging markets, which are more fairly valued. And there really isn't anything really in cheap territory at this point in time. Okay, so let's talk about performance. So this is performance of the full portfolio. 2016 represents the period that the portfolio was invested. This portfolio incepted in August of last year. And you can see we got a muted return for the partial quarter of last year for the third quarter, and then a moderately negative return for the fourth quarter of last year. I'm pleased to report, as we look at 2017, it's a much better story. For the first quarter here, we're looking at a 5.1% return. This is net of fees against the policy benchmark return, which is 4.6%, so 50 basis points of outperformance. I would also note that this is not on the page, but we do have April numbers at this point. It was also a solid month. The portfolio was up another 1.4%, so it would put us at 6.6% against the policy benchmark, which is up 5.8% for the calendar year to date. So things moving in the right direction, and we're very pleased to have put together so far a solid start to the year. I want to caution everyone on the line, this is very early days in the portfolio. It's a good story right now. I actually don't think we should draw any meaningful conclusions at this point, but we do like that we're seeing things going in the right direction here.
If I can add one comment, many of you know and saw returns that we're not particularly thrilled with. And part of the reason for that is as we transitioned investment management from our former firm to Cambridge, we actually had to liquidate the entire portfolio and then invest with Cambridge. So we actually were in a cash position for a short period of time, and that definitely would result in some of the impact that you saw in your fund statements.
Thank you. Great. So on this page, what we're showing you here is the performance by the underlying asset classes that we have in the portfolio against their respective benchmarks, starting with global equities on the left-hand side, U.S. equities, non-U.S. equities, and so forth. And so as you look across these returns, generally speaking, a fairly good story here. Excluding cash, we've added value in 6 of the 9 investment categories that we have, particularly in non-U.S. developed and emerging markets, where both on an absolute and a relative basis, they've been quite additive to the portfolio's return. Again, overall, still early days in a very short period of time, but we're pleased that we seem to be tracking in line with expectations thus far. So the last slide that I wanted to cover is portfolio positioning. So on the left-hand side here, you can see that we stood at $65.3 million as of the end of the quarter. It's closer to $66 million today with April's performance. That left-hand chart essentially shows the split among the different asset classes that we have in the portfolio on a percentage basis. And then in terms of positioning, we are running a slightly defensive portfolio relative to the policy risk profile that we're targeting, which is roughly equivalent to about 70% of equity market risk. And we're running with some moderate valuation-based tilts, an underweight to U.S. equities that we're using to fund 3/4 of a point overweight to emerging markets equities, and then a 1% underweight to nominal bonds, this is treasuries, and an overweight to cash given our view on yields that are particularly low at this time, and we think bonds are a little bit more unattractively valued, and we want to have some lower interest rate sensitivity in that allocation. So those were the main points that I wanted to make, and I'd be happy to answer any questions.
Jay. Go ahead, Jay.
Sorry, I had my...
The conference has been unmuted.
Go ahead, sorry.
Okay, I'm sorry. So has Cambridge been managing the fund just since the first of the year?
Since August. We started in the portfolio incepted on August 1st. We actually worked with the committee in the months before that to set the policy, but in terms of the track record, as of August 1st, that's when it begins.
Okay. What is the Montana Community Foundation's risk tolerance?
So this was the result of... Sorry? No, I was going to say...
Oh, you mentioned that.
Yes, I did. So this is really the result of conversations that we had early on in the relationship, initially some phone conversations, and then we met in person with the committee last year to walk through a couple of different portfolio allocations and what they represented in terms of return expectation and risk expectation, looking at things like volatility, looking at things like potential downside for a given portfolio. And based on that discussion, the Community Foundation elected to choose a risk profile that's roughly equivalent to a 70-30 stock bond portfolio, or roughly 70% of equity market risk. So a very simplified way to think about that, and it's not going to exactly look like this in terms of performance pattern, but a very simplified way to look at like that is if markets were to go up 10%, we should expect this portfolio to go up about 7%. If markets go down 10%, we should expect this portfolio to go down about 7%. So less than the market would go down, less than the market would go up. If our managers can add value, which we absolutely expect them to do, ideally we have some better downside protection as well as some additional upside in that type of situation. Does that help?
So relatively low risk tolerance is what you're saying, I think?
I would actually put it kind of middle of the road. when we met with the committee, we looked at a 60-40 portfolio, which we would put on the lower end, if you will, of the risk spectrum. We also looked at an 80-20, and then the 70-30 is in the middle of the road from our perspective.
It seemed to me that this past year, most of my investments made, somewhere between 6 and 10%, and yet it looked like our endowment, we lost money. And I just, besides the fact that you had to liquidate the entire portfolio, was it poorly managed before August?
Well, I think we'd
I
have
don't
to look.
understand why we lost so much money.
I think you'd have to look at the performance of the portfolio through the period that it was invested in 2016, and then combine that with the performance that you saw for the partial third quarter of last year and the fourth quarter of 2016 as well. It may be that it's a slightly different story than the returns that we're showing you here. We're just showing you the returns for the period that we've actually been managing the portfolio. And it's also, there's a real sort of starting and ending point sensitivity here. Because of the way that, the timing of when things were liquidated, we were not able to put the portfolio to work in July, which was actually a really strong month for particularly risk assets, and so unfortunately we're not able to benefit from that. And believe it or not, that can actually have a pretty big impact on performance. I definitely can understand where you're coming from that perspective. It's a little bit tough to make that apples-to-apples comparison because we would argue that it's not. You were managed by a different provider essentially for the first half of the year, if you will, in terms of the portfolio, and then roughly the second half of the year it was us. So it's unfortunately a little bit difficult to make that comparison, but I can certainly understand why it's a little bit confusing.
Thank you.
Any other questions?
Can I ask one other question? I hate to dominate the questions here.
There are no limits, Jay. Go ahead.
What were you going to say?
No, go ahead.
Okay. So I guess how did our investments do last year compared to average investments?
Again, I can only tell you, for the track record that we were responsible for, how we performed and what was the page? We can go back to that page for a moment. Was it page 15? Is that same page number, sir? One more. That one. I think that's page 15. So page 15 in the presentation, to give you a sense of for the period that we've been managing the portfolio, how it performed, very short period of time for last year. Essentially, for the period that we were managing the portfolio, roughly ended the year flat if you combine the partial quarter and then the fourth quarter between the 70 basis points positive and the negative 70 basis points, so call it flat. Looking forward into this year, where everything was fully deployed, in line with our expectations and again, moving in the right direction for the first quarter and through April. We think that that's a very good return to start the year thus far. But I do think that the 2016 performance that you see is again, largely a function of the timing of when the portfolio was invested. So for that period, think of it as about flat. We'd have to take a look at the performance of the portfolio before it was liquidated.
That's what we need to do.
Yeah.
Are the costs to local endowments going to change, or are the costs going to stay the same?
Actually, the change to Cambridge resulted in a significant reduction in our investment management costs from the previous firm by about 50%. So our investment costs actually went down quite a bit.
Okay.
And just so you know, we report these return results net of fees. So whatever we pay Cambridge or the previous firm, those fees were taken out before we report returns.
So on that previous page, those returns
Those are net of,
after.
those are net of the investment fees.
Okay.
And Jay, not to like name the elephant in the room, but you've raised a great point, and that is that the analysis that we at MCF need to do and be able to give you a good answer to is the overall portfolio performance for the year, not just the period that Cambridge had it, because that's clearly driving your questions. And I can say with some confidence that now that we've resolved some of our technology glitches and have stable staff in the finance and accounting department, we'll be able to get to that analysis.
So that will be forthcoming in the next couple months, probably?
Yeah, I think we could definitely do that in the next couple months, do that analysis.
Okay.
Thanks.
Right. Thank you.
Sure, and I would say, when we went through the RFP process, this wasn't a decision that the committee, the investment committee, took lightly. It was a very thorough, frankly, the RFP that we issued was pretty thorough. And then the responses, the firms responding to our RFP were impressive. And then the due diligence process that the committee went through in interviewing the firms, they all came to Montana. 3 of them were out-of-state firms and 1 was an in-state firm. And the deliberation and decision was a pretty thorough process. And for those of you who aren't aware, the investment committee is made up of MCF board members and non-board members who have, some of our investment committee members are long-standing investment committee members who have been involved with our portfolio for a long time. Obviously, our organization's almost 30 years old, and so this was a big decision. It was an important decision, and I think, these people who are making this decision are just like many of you. They care about the implications of all the decisions that they make. So we're over the moon pleased with results and moving to Cambridge. So Mark, sorry, go ahead.
I'm sorry. The company that managed the portfolio previously, did they also apply?
They did.
To manage?
They did.
Okay.
Mm-hmm. They did. Yeah. So we have a question about how soon will we be, after the close of the quarter, will we be able to have the portal updated? And so generally, just so everyone knows, the quarter or the month closes, and then there's a lag time for the investment advisor manager to provide us with all of the return information. So we typically get those within a couple weeks after the close of the month. And then our finance and accounting department has to do our investment reconciliation and attribute all of those earnings or losses to each individual fund and account for those, and then upload those to the portal. So by the 25th of the month, so March 30th, by April 25th, we will have the portal updated. And just know that that's only for the fund balance piece with the investment returns. The portal is updated weekly as it relates to gifts that have come into each fund and as it relates to grants that have gone out of each fund or distributions from each fund. So the only piece of the puzzle that lags that 3-week period is the investment return information and the fund balance. Does that answer your question, Peggy? Okay. Any other questions? Okay. So the next slide gives you most of our contact information, but I want to, Mary Craigle had to leave for another meeting. I wanted to also give you her information. many of you have that, have reached out to her. She's, you can find all of her contact information, I think, on our website. Her email address is mcraigle, M as in Mary. Craigle is spelled C-R-A-I-G-L-E, at mt, as in Montana, .gov. So if you have questions that you'd like to pose to her as the chair of the investment committee, feel free to do that. Alternatively, feel free to reach out to me. And in the future, we will have Casey Tollefson's contact information on this slide, so you can also reach out to her as our controller and the head of the finance and accounting department. I would also offer that this webinar's recording will be archived up on the MCF website in a few days. The fellow who does that is actually fighting a bug. His entire family is sick. So Riley will get this posted. I wouldn't look for it, frankly, before next Wednesday, given that, but this is archived in case you want to go back and listen to Omar's melodious voice. So with that, thank you all for patching in. I appreciate it. It's great to hear from you, and we'll send you notifications of the next webinar. Thanks very much, everyone. Have a great week.